Hello and welcome to Merck's webinar on gold and gold miners and the ASSA Gold Mining Fund. On today's call, we have Merck's President and Chief Investment Officer, Axel Merk, and from the portfolio management team and in charge of managing the ASSA fund is Peter Militas. At the end of today's presentation, we'll have a Q&A, and I'd encourage anyone to enter questions into the Q&A box as we go through the presentation today. Please also note that this presentation will be recorded and replay will be available in the coming days. And with that, I'll hand it over to you, Axel.
Thank you, Nick, and welcome everybody. As Nick says, this is Axel. I am the President Chief Investment Officer here. Today, we will be discussing gold and gold miners. And for that, please read the disclosure we have here. We try to do a more in-depth dive into gold than we sometimes do. And also when we discuss gold miners, we will be discussing the closed-end fund that we manage. That's ASSA Gold and Precious Metals. As part of that, I'll try to mention that again a little bit later, we will be discussing several of the holdings we have in SAA, and I'd like to emphasize that whatever we discuss about these holdings, be that good or bad, several of these companies have just released earnings, it is not investment advice. It is very, very difficult, or from a regulatory point of view, not possible to give you investment advice. And so to the extent that we hold something, it doesn't mean that we advise you to buy that. And so just want to get that out of the way. We're talking today on a day when the price of gold fell. The gold miners went down about 3% today, so it might be a good time to take inventory of where we are, why we are where we're here. We're spending a lot of time looking at things like the global growth backdrop that you see here. As you can see, these are the purchasing manager indices from several countries around the world. Purchasing versus this is on the manufacturing side versus the services side, and we've had a global slowdown on manufacturing. And if you look at the US line, that's the orange line that's hiding here. That has also dropped. Actually, I'm pointing here on the Italian one. The US line is also an orange line that's dipped down here of late. A lot of fear had been that the global slowdown is coming over to the US. A key reason for the slowdown are the uncertainties that are coming from trade, the global headwinds caused by trade, and the Federal Reserve earlier this year had to decide, well, is this going to have implications for the US? The US economy is a much more services-driven economy, and so are we immune from it? And if anything, can low interest rates help? But the reason why we've had the rate cuts in the US are driven by a global slowdown. And the price of gold since the beginning of the year anyway has done well, hasn't done well of today, but the overall mood in the industry has shifted, and we'll explain more as to why that has happened. Here, going back to 95, our inflation readings, several different inflation indicators, the so-called PCE and core CPE, the core CPE stripping out food and energy prices mostly, the more commonly known CPI, Consumer Price Index. The Federal Reserve is looking more on the PCE side, but many of these indicators have been below 2%, and they've been below 2% for quite a while, and that is one of the reasons why there's been an interesting call about this so-called symmetric inflation target of 2%. Indeed, we draw the line here of 2% because implicitly that has been inflation target for a long, long time, but explicitly only Bernanke formalized that idea. It's something to keep in mind, and this idea of a symmetric inflation target is more recent, at least more recent on the mainstream side. Basically what it means is, the argument is, hey, we've been below 2% for such a long time, and therefore we got to push above 2%. Personally, I have a huge problem with that because you may think of monetary policy what you want, but it's supposed to be forward-looking. It's supposed to be take into account what may be happening forward. And so just because something happened yesterday doesn't mean we should do something going forward. Remember, we had a major credit bust. We had something that could have dragged us into depression. Extraordinary policies were imposed, and that has led then to kind of lackluster growth for many years, a near zero interest rate environment, some countries below zero. And Now we're in a very different environment. Now we're in an environment where unemployment rate is very low, and where we're adding a stimulus through additional lower interest rates. We're also adding a stimulus, by the way, by easing of trade tensions, if that's what you think is going to happen. We have an election coming up, and that's, I think, the key backdrop as to why trade tensions are easing. Remember earlier this year, part of the reason why President Trump escalated trade tensions is because he was accused of being too easy on the Chinese. While he ratcheted them up, then the US economy showed signs of slowing down, and as any president, he likes to get reelected. And so he has an incentive to ease tensions, but he also has an incentive for trade to remain in the news. So don't expect this to be a switch that's turned on and off. It's a process, and it's going to be slight easing of tensions. We're talking about a phase 1 deal. Well, it's becoming phase 0.8, 0.9, because we keep postponing the meeting. And then once we have a phase 1 deal, we'll probably go to phase 1.1, 1.2. I was asked this morning on Bloomberg TV whether I expect there to be clarity, and no, I don't expect it to be clarity. This is a gradual process. The one thing it doesn't help so much on is the backdrop of whether business investment will pick up, because if there's uncertainty, business investments will be held back. That's really one of the stumbling blocks. And so I'll give you here a scenario that's going to talk about inflation more. The key argument against that is that the headwinds caused by lackluster business investments are going to push back against us. This here is wage inflation. Different ways of looking at it. The black line is the so-called employment cost index, and the employment cost index is kind of a cleaned up number. We hear about wage growth in general, but that's often distorted by the count. A seasonal worker is counted the same way as other workers. The ECI is an index that's a cleaner index. And as you see, earlier this year, we had some abating cost pressure, and many economists said, oh, wages are not an issue, is not a problem. Now, the gray line that you see here, offsetting a different statistics, and if correlation is causation, and I say if here, then wage pressures might continue to rise. What we do know is the latest tick has been up. We are near 3% on year-over-year inflation. Powell says that's a great thing, that's a good thing, because people have more earnings power, and it is to an extent. It is to the extent that we have enough people we can pull from the sidelines. We have not had an issue pulling people from the sidelines, and because of that, we haven't had really an inflationary breakout. To conclude from that, though, that when you are at record low unemployment or near record low unemployment, that you can continue to have highly accommodative policy and not think something is going to give, to me is a bit of a dangerous conclusion to make. And what I'd like to show you is here, there's a statistic that's how many people are looking for a job, right? A few and few people are looking for a job. And the gray line here, well, that's just an imaginary line here, but that's just as a mental guide that if we break through this, maybe this is one of the indicators that we might be getting to have a job market that's so tight that indeed inflation is going to break out to the upside. And central banks are telling us, hey, if and when we do have inflation, this is a problem we know how to fix. I couldn't disagree more. I mean, of course they know how to fix it, but there's a big but. We now have a corporate debt structure that is very different from what we've historically had. Because we've had such low interest rate for such an extended period of time, it is no longer fashionable to be AAA rated. It is fashionable to be BBB rated. So how do you fight inflation when an ever-increasing number of corporations have a low credit rating and you ought to push rates higher? So yes, of course, central banks can kill inflation if they want to, but I'm not so sure whether they are aware of the dynamics that they're signing up for in this. So when we compare gold to other things, the one thing we often know is we've compared long enough, correlations break down. The one thing that, at least according to this visual here, gold is more highly correlated to other things, and it does make sense, is to real rates. That means interest rates net of inflation. And that's ultimately what gold is competing with, right? When you get compensated for holding cash should you hold something that does not pay a dividend, does not pay interest? And so that is why price of gold is historically reasonably correlated to 10-year treasuries, or in this particular case, we strip down the inflation component, and then there is a correlation. And on a day like today, treasuries were selling off, and that means yields were going high on the 10-year, and the price of gold was coming down. By the way, so that you don't kind of your head doesn't spend too much trying to read these charts, if you want a copy of the PDF and you are registered here to the webinar, you can drop in the Q&A box that like to have a copy of the slides. Separately, by the way, this is the first time we are also streaming this webinar live, and so if you're listening to this while streaming, then unfortunately you cannot ask us questions, but you are of course more than welcome to register and here participate in the Zoom session. So here, another comparison, somewhat related. We thought several months ago that we had reached the peak in negative yielding debt, and then it started to escalate again. Here we show the price of gold versus the percent of the global debt that's negative yielding. You can take absolute numbers. We have, and Nick, you help me out here, I think we had $22 trillion worth of negative yielding debt. Is that about right, Nick? I don't know whether you're on there with me. Do you have that?
Yeah, yes, that's right. Roughly, I think it was actually about 13 trillion in negative yielding debt by market cap, and gold market cap in terms of number of above ground ounces multiplied by the market value is about 9 trillion.
All right, yeah, so up there. So very significant numbers, and obviously this is as of November 5. Things change quite quickly. On a day like today, we've had yields rise, so less debt is negative yielding, and then the price of gold also came down. Another one that I like to draw your attention to is the price of oil. This price is the price of oil, the spot price, versus 5-year forward inflation expectations. And you would think that the price of oil today does not really correlate to what inflation will be 5 years from now. But historically, there's a correlation. And part of the reason I'm showing you this is at the end of this year, remember what we had a year ago? We had the severe risk-off environment. The price of gold had fallen down quite a bit. You see it here on the chart if you can see my mouse at the end of 2018. So the year-over-year of comparison are going to suggest that there's a significant increase in the price of oil. And so just judging from that, without the stimulus, without other things, that might imply that inflation expectations may also be rising later this year. And if inflation expectations rise, that's real yields going down, that of course could mean that we have something that's more beneficial for the price of gold. A lot of people talk about the Fed's balance sheet and how that's pushing up asset prices. Here we show the Fed as a balance sheet versus QE. The orange area shows the quantitative tightening range. And then, of course, we've had here of late a little tick up, a little is maybe an understatement, in the balance sheet. This relates to the issues that have happened in the repo market. These are the overnight lending markets, where the Federal Reserve has, since the financial crisis, rather than trying to manage the short-term federal funds rate by intervening in the repo market, they've switched to paying interest on excess reserves. Then they realized a few months ago that it doesn't work so well. Then they realized in mid-September, late September, it doesn't work at all, or it doesn't work at all, might be an overstatement, that they need to intervene in the repo market, provide liquidity, and then they realized they don't have enough treasuries to intervene in the repo market. And then they came up with this idea to buy many billions each month for the next months to try to kind of replenish the supply of treasuries at the Fed so they can more proactively manage the Fed funds target rate. And they tell us this is not QE. Now, I even agree that it isn't QE, but I happen to think the communication strategy around this has been very bad. In my view, they should have just bought a swoop of treasuries and be done with it, rather than dragging this out over months, just as they did on the QE phase. But in any case, the balance sheet is growing. And by the way, I just use here the Fed as a placeholder. The Bank of Japan has continued to grow its balance sheet, and the European Central Bank has is starting to resume buying bonds as well. So we have again a global expansion in balance sheet, and and we'll see what the implications will be for that. Let's look at the price of gold. The one reminder about the price of gold is, and we're showing here since the early 70s, since the price of gold has been allowed to move in US dollars, that it has had, this is as of October 31st, an annualized return of 7.85%. Gold is something that I sometimes joke that you're always glad to have had it with hindsight. You never quite know where you have it going forward. And this is, and then one of the reasons you have it is because the correlation to the S&P 500 is near zero. Here we show 0.00. Depends a bit on how you measure it. In this case, we measure it versus monthly returns. But no matter how you measure it, the correlation of gold to risk assets or just about anything else tends to be very, very low. And it's one of the reasons why investors are using gold. On this, at the next chart, I show you gold in other currencies. A black line here is in US dollar, but if you look at the euro, we reached an all-time high not long ago. And if you look at the yen, it reached an all-time high. Or if you look here in other currencies, this is the South African rand, for example. Also here, the Australian dollar in black. The part of the reason we show in the Australian dollar, Peter will talk more about that, is because we, ASSA, invest extensively in Australia these days. It's one of the major changes and shifts that have happened in the portfolio. And also here the loonie, the Canadian dollar. And as I'm slowly bridging here towards talking about more of the miners, these things matter because if you're a gold mining company, obviously there is the cost of mining and then there's the price of gold. And so the profit margin really depends on that. And so the dynamics between the price of gold and gold miners tend to be a tad different, but they are very much related. Just gold here in general versus bear markets. Historically, and since the early 70s, gold has been a good diversifier in bear markets, with the one notable exception here in the early 80s. In the early 80s, the key difference is that the bear market in the S&P was induced, I would say, by a rise in real interest rates. Remember Volcker pushing up interest rates quite substantially. And so that is a competitor. Higher real rates, getting compensated for holding cash, is a competitor to gold. Otherwise, yes, in a recession, often gold is doing well. And a good reason, one reason to think about it is that in a recession, you have more volatility. That means risk assets get discounted more. Gold not having a cash flow doesn't get the same discount, so gold shines in a recession. And to just make a broader point, in the current environment, I have indicated a few times now that investors want to have their cake and eat it. And what I mean to say with that is if we were in an environment where people would be scared, they would move to cash. But we're in an environment where people want to hold on to their gains and the equities and are not sure whether we're at the end of a bull market. And I'm not alleging that we are, but people want to diversify. They don't want to take chips off the table. So instead of taking chips off the table, they're adding another something that's risky. And so they're adding gold, for example, or they're getting gold miners. And gold miners, of course, are most volatile, as we'll see and talk about here more in a second. But it is one thing that we see in the markets. And of course, if you want to be defensive, well, then you want to go to cash probably, because that's really the one thing that doesn't move. That the only thing you lose there is purchasing power over time. So I showed you. This is gold versus the S&P 500 here. Again, here the correlation shown a little differently. ETF holdings have steadily been going up. Over the recent 2 weeks or so, we've had some slight declines. We don't have the numbers from today yet, on a day when price of gold has come down more significantly. And part of that is that gradual diversification. Gold has moved out of the shadow, so to speak, again, and people are looking at it more actively from a diversification point of view. One point I like to make here, and I'll talk about miners here more in a second. I talk about real interest rates and all kinds of things, and the Federal Reserve doing things. A lot what is driving the 10-year yield, and with that the competition to the price of gold, is what's happening on the trade side. The short-term interest rates, yes, they do have an influence, but one of the reasons I've been critical of the rate cuts is that you cannot influence trade policy with an interest rate cut, and say the kind of the long-term growth prospects of an economy are not something that the Federal Reserve controls. The reason why rates are negative in the Eurozone, on some countries at least in Europe, is because people don't have a good reason to invest in the long term. Maybe they're worried about the fiscal sustainability. Maybe they're worried about too much regulation. Maybe they're worried about unpredictability of regulation. And similarly in the US, when you have an unpredictability on trade, when it's more difficult to conduct business, the long-term yields go down. When you have an easing of the trade tensions, those yields tend to go back up. Don't show too many short-term charts, generally speaking. These are CFTC data. The CFTC is the agency that regulates the futures business. If you're active in the futures market, you have to do a checkbox on whether you're a speculator or a hedger. And this shows that in recent months, there have been more speculators being long gold. And that then, of course, can set you up for downdrafts such as the one that we had today. Here is a ratio that you see of the gold miners versus the price of gold, suggesting that gold miners are quote unquote cheap versus the price of gold. Again, this or any other comment here is not an investment recommendation. There are many reasons why this has happened. One of them is that obviously gold miners are more volatile than price of gold, and so on the way down, it's not too surprising that things hadn't worked out so great. And part of that has been related to kind of how gold mining companies have been mixed. A lot of the issues gold mining companies have had, some of them have been addressed as they're more cost conscious. The other challenges that especially some of the bigger companies have, and I'm not going to take too much away from what Peter's going to talk. Here is the same gold miners index versus the S&P 500. And here the gold miners versus the S&P 500. And so one of the arguments to invest in gold is the correlation to the S&P is low. Well, if you take the gold miners, the correlation to the S&P is also low. Mind you, though, that any correlations, they tend to break down. And so there are periods when it's positive, there's periods when it's negative, but in the medium term, this correlation is quite low. So with that, I'll hand it over to Peter, and we'll play a little bit of back and forth. He'll run most of the next slides, and then I'll chime in once in a while. If you do have questions, please chime in. And then I indicated in the beginning that I would repeat something. I'll say it now again. Anything that we mention here, especially as we dive into the holdings of ASA, is not investment advice. And so that allows us, just please keep that in mind. So if we say something nice about a company, it doesn't mean you should go out and buy them. One of the biggest challenge of kind of taking that sort of information and just go out with it, we're not going to be there when we change our mind, right? And even if we say something positive, we might change some holdings. Now, on the plus side of things, we try to be as transparent as possible. And Peter, here, take it away, and I'll chime in once in a while.
Thanks, Axel. So this slide is we've used in the past, and it shows the different beta relative to the gold price that the certain market caps in the group have. And I like to show this just as, we've been managing the fund now for 8 months, and we've made a pretty big transition out of royalties and large cap back into the small and the mid cap names. And as this shows, the movements in the price of gold will be, in our opinion, higher on some of the names that we invested in, and mainly because we've been focusing on a positive opinion on the price of gold over the short to long term, and would like to have better, and feel like our investors would like to have better leverage to the gold price.
And so the one thing I'd like to chime in here briefly is that we had many questions pre-submitted, and we'll try to get some of them at the end, and please feel free to submit any during the webinar here. One of the questions that had come in is that, oh, somebody's kind of looking at royalty companies, should they invest in royalty companies? Well, the first answer is we can't give investment advice. But the other answer is that just because we shifted out of royalties into what we call into the mid-cap companies, more significantly, doesn't mean royalty companies are bad. They have the price of gold, royalty companies, mid-cap, large-cap, development, exploration companies, they have different risk profiles, and they mean different things for different people. And so royalty companies, if you are a gold mining investor and this is your space, you might want to shift to royalties if you want to be more defensively positioned. But that doesn't mean they're bad investments. So just because we reduce royalties doesn't mean they're bad. We just think that in an environment that is friendly to gold, you might want to have something that has more Peter calls it torque. I call it more assertive, a tad more leverage to the price of gold.
Okay.
Peter.
Another slide that we've used in the past, just showing the progress that a lot of the companies have made over time, decreasing their all-in sustaining costs as the price of gold has come down. And you can see with the price of gold going up over the last time, most of the improvement in gold has dropped to the bottom line in the form of margin, whereas in the past the costs kind of rose and fell in line with the price of gold. And we also like to show the gray line, which is the production future and predicted production based on models that CIBC did. Their coverage space, which is pretty inclusive, and it shows that a lot of these companies have declining production profiles over the next 10 plus years.
And by the way, one of the reasons they have declining production is because they've contained their costs, right? Because they have not invested more. Also, what happened during the last bull market in gold is all the stakeholders wanted to have a bigger chunk of the action. The workers wanted higher wages, energy prices were rising, the governments wanted to have higher taxes. And then what tends to happen towards the end of a bull market is that investors are pushing companies to get more ounces under the belly, and so they make costly acquisitions, meaning the focus on cost goes away. Now that we've had many dry years, there's quite a bit of focus on the cost side, I would argue. Peter?
And over the last 5 years, balance sheets were stretched, and a lot of any excess cash flow was spent fixing the balance sheet rather than in the past when they've moved into exploration or M&A. And so this slide again was also what's showing is the amount of Capex that the companies have been spending leading up to the peak gold price in 2012. And like we said in the last two slides, a lot of the focus was on cost cutting and balance sheet improvements. So the Capex was not spent as significantly as in the past. That can change. Where this one is showing that Capex is going to be going down, but I can tell you that as gold price improves and cash flows drop to the bottom line, the Capex should increase over time, but a lot of that will be in M&A and growth projects.
So, go ahead.
That's on. Okay, next slide.
Yep, I think that is, all right, here we go.
And then again, this is just showing how in the early 2000s, free cash flow was hard to come by. And over time, as the gold price improved, we've started to see the increase in free cash flow. So 2019 going forward, we're going to have some very significant free cash flow that the companies will have to invest in improvements to their current projects, but also they'll need to increase production to offset the production decline that's shown in the green line. And we believe that moving down in market cap is a way of capturing that type of performance as bigger large cap and mid cap names look to improve their production profiles.
Any particular gold price forecast in this model? Do you happen to know that?
It's using spot price.
All right, and so now we're going to shift gears kind of from the broader industry overview to ASA. As many of you are aware, we took on the management of ASA Gold and Precious Metals in April. It currently has 294 million in assets, and it's a closed-end fund. And what's unique about it is in some ways that you can quote unquote buy gold at a discount, or gold miners at a discount. We'll talk about the kind of the proposition of this more in a bit. This is not a fund that accepts new money. The last time it raised money was in 1958. And so there's obviously no guarantee it will ever close that discount. The discount is sometimes wider, sometimes narrower. It widened since we've taken over a little bit. Part of that may be the reasonable performance, good performance versus its peers. If you think about it, when we outperform it, and the market doesn't expect that, that would get the discount to widen. And we'll talk in a few minutes here a little bit about some of the things we do in the fund, and that may help explain as well why the market isn't always aware when we have a good performance. The one thing I'd like to mention, please read the disclosure here on the bottom. ASA is actually a Bermuda-based company. It's a closed-end fund traded on the New York Stock Exchange, but it's considered a foreign investment company. And we can't give tax advice, but if you do hold it or hold it for clients, you might want to hold it in a retirement account, a tax-deferred account, in order to not have negative tax implications. Reach out to us if you want to know more about it. Many mining companies, by the way, are classified that in any case like that anyways, if you invest in those directly. But for the time being, Peter, if you want to talk just in broad strokes about the investment strategy, and then we'll dive into a little bit more detail. Peter?
Yeah, and so we've been leveraging my past history at Franklin Templeton over the prior 8 to 9 years, where I was the precious metals analyst, and I've been focused on the gold and mining in general, but I've had a primary focus on the gold sector. So I've done deep dives into a lot of the companies, met with management many times, have a very solid base of investment relationships where I have contacts both on the geology and engineering side and on the research side that I can reach out to that can give me knowledge on assets that I'm not familiar with, or just confirmation of what I'm thinking. We've traveled to over 30, 40 countries and visited many of the sites in the portfolio already, and continue to have that. Think that's an integral part of the process of figuring out what are the best investment opportunities.
All right, let's just continue here. Peter.
Okay, again, I have a preference for gold versus other precious metals. So 90% of our NAV is in the gold miners. The diversified miners, a little under 5%, silver under 4%, and platinum and palladium a little less than 1%. We just have a feeling that gold is a better proxy for the appreciation in inflation and the like, and that silver and some of the other commodities have a little bit more exposure to the industrial component of the economy. At times they can outperform, but we believe that gold is where most people want to be. In terms of country of incorporation, Canada continues to be where the majority of our holdings are, 65%. We have increased significantly over the last 8 months into Australia, where we are currently right around 17%. South Africa has remained pretty stable at 10%. In Canada, again, this is a country of incorporation. The companies have assets all over the world. So we will say that we're in Africa, we're in Asia, we are in Australia, Latin America. We're basically all over the globe in terms of where the assets are.
And by the way, one thing we weren't fully aware of, but we're increasingly aware of, some brokers don't allow their clients to invest in some of these countries. And so you may want to look at a fund like ASA in order to get access to these countries. It's obviously easier to invest international than it had been in the past, but there are still some restrictions there. And then obviously we give you the benefit of doing a deep dive into the various companies. Peter.
And these are new charts that we haven't shown as regularly, and part of our increased disclosure on the fund. The capitalization of the companies in the fund. Prior management had a preference for large cap and royalty companies, which were much greater than 25%. As you can see, what we consider the mid-cap names between 2 and 10 billion are now 39% of the fund. Smaller than 2 billion small cap names are 35%, and the market cap for the large caps, the average is 25%, and that's gone down significantly. Again, continuing with the theme that we believe that we're in a positive environment for gold, and leverage to the gold price is where we'd like to be. So we're moving down market cap to get a better exposure. In stage of development, again, this is a significant differentiation from prior management. Mid cap, we consider 500 to 1 million ounce production, that's 36%, and then less than 1 million ounces in production, that's 35%. We believe there's larger breadth of names that are better suited to increase in price over time, and that's why we've focused on those names. We've also increased the exposure to exploration and development companies, as previous slides showed, that we believe that some of these companies are going to need to go to the M&A route of how to increase their production profile and get development projects and exploration plays into their portfolio. So that's why we're moving in that direction. A lot of the larger companies also use the exploration companies as they'll invest in these companies and use them as their so-called greenfield exploration projects, because they'd rather spend the money there and have some people that are focused solely on looking at new projects rather than have their internal exploration teams looking at the greenfield project. And so they let the smaller management companies find the assets and prove them up, and then they don't mind missing a certain amount of appreciation in those companies, and then they can take it out and bring it into the fold and use the large company processes and procedures in developing these projects. And then again, mining versus development and exploration companies. The fund is typically always has been primarily in mining companies, but we've increased the exposure to exploration and development companies and significantly decreased the exposure to the royalty companies. We've gone down in market cap. We've exited a number of the royalty names, or a royalty name, and decreased the positioning in some of the large caps and invested in smaller royalty companies that we think have the chance to become the next larger royalty company.
So let me just chime in here on two items. One is the numbers you see here. We starting with the last month, started to publish these numbers on a monthly fact sheet. The monthly fact sheet used to have some data, but we have become much more transparent in that. Part of that is to communicate to you of what we do, to have you understand what you do, and understand also the portfolio dynamics a little bit better. Now, let me just go back here to the previous one. One of the things that you see here is we have 17.5% in Australia. Well, the Australian market closes earlier than the US markets. And so one of the things you'll see is that sometimes the NAV doesn't kind of move exactly the way you might expect it to. That's because we tend to use an Australian closing price, and often don't see a reason why that price should be adjusted, because we don't know any better than the closing price. And so we do take the closing price of the Australian close for purpose of calculating the NAV on that day. So that's one thing, one tidbit here to just be aware of. The other one, to maybe Peter can comment on a little bit. If you look at this sort of portfolio, you say, all right, you compared it to the previous management. You want to just contrast that to kind of some of the main indices, the underlying index to GDX, for example. And there's no investment advice to GDX, but that being obviously the passive index of choice, ETF of choice here for many investors. You want to just give a little bit of flavor of how ASA is different from GDX.
Yeah, so the GDX and the FTSE Gold Index are heavily weighted towards some of the larger companies. The FTSE Gold Index has Newmont and Barrick as their top two holdings, and is over almost 38% of the fund is in those two names. And then in the GDX, it's a little bit broader in terms of the names that they have in the fund, but they are still over 20% of the fund. And so we have decreased our exposure to those names, as we feel that some of the integration risk in the M&A, the acquisitions that they've done, potentially has a problem for performance going forward. One other thing I'd also like to say is that part of the, in terms of fuller transparency and disclosure, we've started pricing the NAV on a daily basis. Prior to our taking over the fund, the NAV was calculated on a weekly basis, and we believe that this type of pricing on a daily basis will give you better understanding of how the portfolio reacts to the gold price and the changes in the portfolio companies.
All right, I switch to the next slide if you want to talk about what warrants do in the portfolio.
No, and so part of moving downstream is we have the ability to participate in some equity raises that some of the smaller companies do to help fund them in the development of the projects or exploration. We tend to have a preference for companies that have good partners that will be there to help support further fundraising needs as these companies grow. And part of that is you get equity plus warrants, and the warrants are essentially options to buy shares at a higher price if the price of the stock reaches that at a later date, and typically 2 to 3 years out. It gives us a little bit more optionality. We value them on a Black-Scholes model basis, and as the price of the stocks get closer to the warrant exercise price, the warrants end up increasing in value at a higher rate than the equities. Just one note, the Integra Resources warrant that we have there is actually not a warrant. It's the right to buy equity that it converts into equity in December. So it effectively is additional equity that we own in Integra Resources.
Exactly, it's a warrant and label, but it's not. There is not huge leverage in that position. It pretty much reflects what the price is trading at right now. Yeah, and just one thing to expand on what Peter said. In the past, gold mining companies, especially the junior ones, they always, not always, but they often need to raise money. And in the past, that capital was provided by mutual funds and other players. Those are much more constrained these days because because they've just shrunk in size so much because of the headwinds the industry had faced, and many of them are stuck with illiquid holdings, and so they're much more capacity constrained. And so because these mining companies may need additional money going forward, you want to look for companies that have other solid backers, and that's one of the key things that Peter's looking for as he's participating in some of these deals. Peter?
Yep. Okay, so here's our top 10 holding. It's changed a fair amount since we took over. 47% of the assets are in the top 10. As you can tell, Barrick and Newmont have definitely gone down in the top 10. We've used selling those companies as sources of cash to sort of invest lower in the market cap. And then the royalty companies are completely out of the top 10. We do have a preference for good management teams. That's why we have a name like Agnico, which we really haven't sold much of, is now in 8% position. Another interesting development over the last week or two of earnings is that a number of these names have started the process of increasing or instituting dividends, and we haven't seen that in the industry for a long time, as a lot of the cash is necessary for debt payments or Capex on growth projects. Agnico Eagle increased their dividend by 40%. They've paid a dividend for a very long time, but it's a pretty significant increase for them. Barrick increased their dividend this week. And then B2 Gold instituted the very first dividend that the company's had since the creation. And so what we're seeing here is that, while these dividends for the most part aren't as substantial as some of the big dividend paying companies in the rest of the market, it's an indication of companies that are getting more comfort with the way their balance sheet is and the way the companies are progressing and the way the cash flows are dropping to the bottom line. And I think, as a lot of people would say, is it's a good indication of how to keep management on track, and to maintain a dividend is very important. And they don't do this lightly, and they look to continue with the dividend as long as they can, and hopefully this keeps them paying attention to the way their businesses are being run.
Do you want to just comment on the price of gold that these companies need to be profitable, that you think they're working with as a baseline, and then conversely, what guidelines we have before investing in any mining companies on what the probability is, in the context that, like a day like today, obviously the price of gold came down, mining companies were hit pretty hard. Are those companies suddenly not profitable anymore? Give us some flavor here.
Yeah, I mean, I think as one of the earlier slides showed, the margins that we have over current costs is pretty significant relative to the way it has been in the past. The price of gold has increased over $200 in the second quarter, and the majority of that dropped to the bottom line for most of these producers. And so when the gold price improves that quickly, it takes a while for companies and the market to really adjust that price. Prior to the $200 move, most people were using $1,200, maybe $1,300 gold for plan, more like $1,200 gold. And so some of these companies, we were at an industry conference back in September, and one of the questions we asked all the companies was, how is your pricing changed? And most of them said they're trying to stick with $1,300. Most of the analysts are still at around $1,300, some moving up to $1,400. But as you know, even after the move we've had today in gold, we're still closer to $1,500 we've been in a long time, and that is basically showing profitability for the majority of the companies out there. Okay, and here is the sort of the middle tier of our holdings, names that are anywhere from 2.6 to 1.6% of the fund, represents 38% of the fund holdings, and I'd say this is where we're going to get a lot of our leverage to the gold price. A number of Australian names in there, and a number of smaller development projects and producers that are ramping up production. And so as their businesses improve, we look to see the stock price appreciate accordingly.
Anything with regard to earnings you want to talk about, or rather not? I don't feel obliged if you don't want to.
Yeah, no, I mean, I think most of these companies we've seen, there's surprisingly in this environment a number of the companies have had some missteps. So picking the right companies is still very important, and so I feel like we've had our fair share of companies that have did not but they had issues in their quarterly reports, but for the most part, I think we've fixed mostly winners.
And just as a broader comment, in this industry, there will be operational issues periodically. And if you're a large diversified company, you can hide that more or less. I mean, it will still be noteworthy. Whereas if you're the more of a single project mining company you are, the more pronounced an impact it may have on your share price. And that's obviously why one holds a diversified portfolio to spread those things.
Based on our past looking at the gold companies, we feel that we're in a position with the size of the fund and our understanding of most of these companies that we can take advantage of what we perceive as mispricing in the market if some companies are overly punished for what the market sees as a misstep. Mm-hmm. Again, these are probably more the exploration and development stories that we've been participating in recently. These are companies that are on the cusp of significant discoveries or mines that are developing to a point where they're going to start seeing hopefully cash flow. And this gold environment is very positive for these types of companies as it makes it's a lot easier for them to handle a ramp up. And then once they start the ramp up, they can cash flow drop to the bottom line.
All right. Do you want to make some general comments? I can chime in otherwise as well.
Yeah, no, I mean, the opportunity we have here is we think is pretty significant. As Axel kind of alluded to at the beginning of the presentation, we're pretty constructive on the gold price. There's going to be some fluctuations as we saw today, and I think a lot of it is around the uncertainty around the China trade negotiations. But I think that's a short-term headwind. But for the most part, we believe we've positioned the portfolio in a way that we're going to take advantage of the potential increase in the gold price. What I really like about the group we have here is I have Axel and Nick and the team that are very good at the global macro, and we have daily discussions on the world economies and how things are affecting, be it the Fed or the economic releases of different countries. And so I have a much better knowledge of what the world's doing and how that, and incorporate that into my thinking about the gold price. And then on the discount, I mean, historically the discount's been high at ASA. It's gotten higher. Part of what we're trying to do is be more transparent, make sure that we have these webinars. We're increasing the exposure that the fact sheet has and where people can have a better understanding of what ASA is investing in. And so we're looking to make sure that the market has a better understanding of what we're doing and how we're doing it, and so that they can have a better idea of why the discount's there and why it shouldn't be there. And I think historically people had a different opinion of the way ASA was investing in the gold market, and we need to show that we're doing it differently. And I think the performance of the fund relative to our peers and to the indices has been very good, and I think that is why the discount is increasing. So we think the opportunity is that you're getting a discounted portfolio of gold mining assets that has potential just to re-rate on its own, and then if the gold price goes up, you're going to do well as well.
Yeah, no, thanks for that. And to just provide some additional color to this. Ultimately, why should you invest in a closed-end fund? When you can buy an ETF or can stay away from the space, obviously, you may want to make a decision whether you want to be in the space or not. And by taking on an active management, there's an opportunity to outperform the major indices. On the first run-up, they tend to get the money, but then as the kind of the trend continues, the money is going to be, in our view at least, more differentiated, at least historically speaking. That has been the case. And it's one of the things we can do in this fund is to participate in these offerings, for example. And this is something that most investors don't have access to. The ETFs certainly don't do. And so there is an opportunity here. And I mentioned earlier, this is one of, sometimes you participate in these things at a discount. And so you get an immediate little bit of pop, and not huge. I mean, you see that these holdings are very small, but that helps explain why the discount sometimes moves higher, because investors can't possibly know until we've disclosed it as to where the added performance has come from. And so one of the things we do is we try to communicate actively through this webinar, through many channels. Please reach out to us with any questions. But the other part of it is also we see that there's increased traction for the space as a whole, and ASA specifically, just based on the conversations that we have an increasing number of conversations, everything from retail investors to institutions wanting to learn more. And so part of our goal is to obviously get new faces to look at ASA. And with that, have that fund represent what it is, and be a vehicle that can be a very, very interesting vehicle to many people. And so before we open it to Q&A, kind of a few comments. One is that, as Peter alluded to, we do other things at Merk. He mentioned Nick's name. He's our master of ceremonies, but he's much more than that. He manages separate accounts. He manages also our research publications. We publish a fleet of charts every month where we discuss everything that's happening at the Fed, to the business cycle, to the S&P. And so browse our website to find out what we do there. And then we can take on other mandates as well if anybody has any particular needs. We're obviously also known for what we do in the currency space. And as you've seen today, we talk about the gold mining fund. We're not talking about our physical gold ETF. Our different products are regulated differently, and so we will reserve that for a separate webinar down the road. But please, to the extent you have an interest in anything we do, drop us a line. Let us know what you want us to talk about, either one-on-one or in a webinar. This is a placeholder chart to just briefly once more talk about the trade tensions. Yes, I am long-term positive on the price of gold, but I don't think it's going to be a straight line. Today was a case in point here that as these trade engines may ease in the coming months, that's going to be a headwind, and it's going to be offset by other forces. I mentioned inflationary pressures potentially going. I mentioned sometimes I actually see a risk of a potentially hot economy because we're putting so much stimulus into an economy that's already at record low unemployment. That is a scenario that's currently not priced into the market that could well lead to quite some volatility in the markets, also volatility in the price of gold. And so ultimately, investing in gold or gold mining is a diversification story. These companies are profitable in this environment, and so it really depends on anyone's horizon as to when they want to have how much. And given the volatility, obviously, you might want to think about the sort of exposure to have to any one of these instruments. So while you read the disclosure, and again, please look at the ASA exposure, that you may want to have ASA in a tax-deferred account if you're an individual investor. Nick, if you want to manage the Q&A, go ahead.
Thank you, Axel and Peter. So if anybody has questions, please feel free to still type them into the Q&A box. So first question here for Peter is regarding whether the fund mandate has taken any directive to being overweight names that could be candidates for inclusion in either GDX or GDXJ.
We don't have a mandate to do it, but we definitely are aware of anything that is on the cusp of being brought into or taken out of the indices. And sometimes if we see the opportunity, we'll try and take advantage of it. We don't like to trade around it too much, but if we can see names that we like and may even already have positions in, we try and add to them if we think there's an opportunity.
The one thing to add to that maybe is that in Australia, that is particularly a sensitive area because Australian investors are quite index sensitive. And so several of the names we hold might be at some point included in index. And so there is probably a potential for upside as well.
All right, then moving on to a question on the discount. There's a participant asking, with the present discount to NAV why don't you start buying back ASA shares in the market to reduce/eliminate the discount?
Yeah, so let me take that. That's a question that comes up periodically. When we took over the fund, we had less than 200 million in net assets. At that level, it is very challenging to buy back shares because of the operational cost of managing a fund like this. One of the reasons why the mandate was given to an external manager like us was to have a greater efficiency in running it, and I believe that's been working very well. It is a decision that the board will have to make periodically. That topic is going to get on the table. I'm not aware of any very active discussion of that right now, but it is something that will periodically come up. Now, all that said, if you look in the history of closed-end funds, the buying back of shares usually only reduces the discount on a very short-term basis. And so if you're a multi-billion-dollar fund, you can do that. On a smaller fund, the question is really what is the long-term value to the investors that remain in pursuing that. It doesn't mean it's not going to happen, but it is a discussion that's not quite a simple thing. Hey, there's a discount, let's buy back some shares. Because there is a potential cost that's then rolled over to the remaining investors that then have to have a higher carrying cost of the fixed cost of running a vehicle like this. And so it is a question that always will be there. At this stage, we believe the important thing is to communicate our process and then to execute on a process, right? We have to show that we can do what we say we do consistently for investors to embrace that. And then part of that is the communication as we do with a webinar such as this one.
And we'd also like to I'd also like to say that we believe that the opportunity for the appreciation in the gold mining stocks is greater than buying back our shares. So we feel like the opportunity for investors is that the fund will significantly outperform in a tape versus buying back shares. And so we'd rather have that to invest in.
We have to ask ourselves once in a while, what's the raison d'etre for a fund like this? And part of it is to provide capital to the industry. And Peter has embraced that. I think it's a fabulous way to deploy a closed-end fund because that's ultimately, this industry does need money. It's good to have a fund that is able to do that. And we are grateful to have a manager who understands how to work that segment of the market. Nick?
There's a question here on market caps relating to trading in maybe less liquid names regarding lower market cap stocks. This question pertains to companies that are sub 100 million market cap. I think that you covered this, Peter. Are there any holdings below 2 billion in market cap, or
yes?
Do you have any liquidity issues trading those names?
So, I mean, there's always going to be concerns about liquidity on certain names, and in an up tape, it's not a big problem, but on a down tape, it's always a concern. And so, part of the issue, though, the beauty of a closed-end fund is we don't have outflows, so we don't need to sell things if we don't want to. And in an open-end fund, if you have outflows, you need to raise money, and sometimes you don't want to sell your larger names, and you force sell your other ones. That being said, we like to take advantage of those opportunities, and the market is one in which in the sub 2 billion market cap set, we have the relationships on the street where we know where certain blocks are, and if we can find liquidity, we'll take advantage of it, either if it's a sale or a buy. We sold some of the larger positions that were legacies that would have, if you look on a daily trading basis, it would have been almost impossible to sell. But we can find people that are interested in taking advantage of that. So while liquidity is always a concern and something that we're looking at, we have the ability to buy and sell large blocks of shares that are there.
And just one more comment, as many of you have seen and many of you have appreciated, we're disclosing now on a monthly basis our holdings, but we are disclosing the percentage of net assets. We're not giving the precise number of shares. And part of that is that to the extent that we hold some of the less liquid names, we don't want anybody to have the impression that if we get up or down by a few number of shares, that we suddenly want to reduce our stake in that. We don't want to send wrong signals to the market. And so there's a balance to be struck in the transparency. Most funds do not go into the transparency that we have to disclose. We're now just a few days after the end of the month, and we're disclosing the full holdings. And so we're trying to strike a balance here with being as transparent as possible without signaling to people that there's any small name that we were buying or selling. And again, nothing that you see here, please don't see that as an investment recommendation on any particular security, because there could be many reasons why we may have increased or decreased the security. Doesn't mean we don't like it. And so similarly, we decreased the large mining companies. Well, they may not be bad companies, but we have other uses for that cash. Peter, Nick, go ahead.
Another question for Peter here is, when do you think gold developer companies will see some torque in the space? And I'm guessing that torque maybe refers to upside here generally, but maybe you want to define that term as well, Peter.
Yeah, no, I mean, I think when they mean torque, they mean when are they going to benefit from the gold price? And I think when, you know, there's a lot of the development companies are starting to put out different studies that'll show the economics about the projects they're looking at. But I think what we're going to need to see is some of the mid and large cap companies start entering the M&A space, and so people will get more comfort that the big companies are open for M&A. I think we're getting closer to that point. We haven't reached it yet. There's definitely a number of processes out there where the large companies like Merk and Newmont are looking at their portfolio after the acquisitions of Randgold and Goldcorp respectively, where a lot of companies are trying to figure out what they're going to do. And once that starts happening, you'll see people move down in market cap, and that's when those companies will start participating. That being said, they're still participating. I mean, we've definitely seen some of these companies are doing quite well in this market, but we can see them do even better when M&A starts entering the space.
Yeah, and to just kind of emphasize that once more, the large mining companies, they, in our view, will need to increase the reserves they have. They don't have enough. They have underinvested over the years. And so they will have to go out and buy things. And that's part of the reason why we've positioned the portfolio downstream, because some of the names might be taken over at some point at a premium. Not all the takeouts have taken place at a premium, but that, in our view, will increasingly happen if the tailwinds are going to persist in this segment. And so we think that the portfolio is well positioned for that, and will continue to look for such opportunities. Nick?
I think we have a couple participants tuning in from Australia and New Zealand with some questions about whether Australia and New Zealand residents can invest in ASA. Axel, can you comment on that?
We can't. Well, first of all, the ASA is traded on the New York Stock Exchange, and for that, anybody who has access to buying shares on the New York Stock Exchange is able to invest in ASA. And so from our perspective, there is no restriction. Indeed, it's an offshore company from a US investor's point of view, so US investors may want to hold a retirement account. I do not know the tax implications for a New Zealand or Australian-based investor. They need to do their own homework. But from our point of view, we welcome investors from anywhere in the world. Indeed, we do have investors from both Europe and kind of the down under, so to speak. And so we certainly, we're not going out there and actively trying to look for investors, but we very much welcome them. And to the extent that any investor there has questions, we're glad to try to address them with regard to the portfolio. Unfortunately, with regard to tax implications for investors, we're not authorized or even have the knowledge of what it exactly means for investors from down there.
Okay, we'll move to a final question here, which is a general question I'll put to you, Axel, which is, what are the positives and negatives of investing in a closed-end fund like ASA versus an ETF such as GDX?
Yes, so thanks for that question. We tried to address that a little bit. When you buy a GDX, you're obviously getting a basket of securities, very much top-heavy, meaning a lot of emphasis in the largest players in the field. Historically, in the first movement in the price of gold, they tend to, that's where the money flows first. When you go though downstream, so to speak, you get use the word torque before. You get more torque, should get more torque, and at least you should get a little bit more leverage to the price of gold going downward. So it depends a bit on the risk profile, and if you go all the way down to only work in the juniors and on the very small ones, then it can become a casino. Then it's all over the place, and so some people like that. That's not our cup of tea. We like to have a more assertive fund, and so you get that obviously when you invest in a portfolio as we have positioned it now. Now, obviously, the other big difference is that a closed-end fund does trade at a discount, whereas an ETF tends to trade at the NAV and very, very close to it. And so that's both an opportunity and a risk, right? If you believe that we can communicate, if you believe that the development in the space, our communication efforts and our execution efforts will help to lower the discount over time, well, then there's an additional opportunity. If you believe that the discount will increase, obviously, then that's more of a risk. Peter, anything to add to that?
Yeah, and I think if you look at our performance since we took over the fund on a comparison basis to the ETFs and the indices, we have performed in line or better than most of them. So I think in addition to getting the discount potential re-rate, we're trying to show that the fund can and will likely, hopefully, I guess, perform in line with indices, unlike it has in the past.
Yeah. So before I hand it back to Nick, if you have any questions that haven't been answered, feel free to submit them either in your box, send us an email, go to our website. All the information is on asalimited.com. If you go to Merk Investments, you can also click yourself through to ASA, and obviously always give us ideas on what you want to have webinars about. Down here, by the way, I have some social media icons. We're live streaming this on social media. This is the first time we're doing this. Give us some feedback on how that works. And if you want to be very involved in what we do, Twitter is where I am the most active, so to speak. I give short-term assessments of the market and other things. If you're more interested in kind of the longer-term things, try to be on our mailing list where we give you information on our research reports and obviously on upcoming webinars. Back to you, Nick.
Nothing further on my end. Thank you both to Axel and Peter.
All right. Thanks, everybody.
Thanks.